Hi, everyone, and welcome to Sustainability in Motion podcast. We explore the fast evolving world of sustainability, helping professionals understand how environmental, social, and governance practices are reshaping business, finance, and the skills needed to thrive in the changing world. I'm your host, Maria Maisaradze, founder of ED4S. If you've been following our podcast, you may notice a new voice behind the mic. I want to take a moment to thank Matt or Zach for hosting our earlier episodes and helping shape this platform into what it is today. I'm excited to continue the conversations, bringing the fresh insights, voices, and stories from across the sustainability and finance ecosystem. In today's episode, we will focus on business case for sustainability in banking, more specifically on green banking. It's a pleasure to welcome Jason Taylor, founder of Climate Finance Advisors. Jason has over 20 years of experience at the intersection of capital markets, sustainable finance, and philanthropy. Jason, it's great to have you here on the show with us today.
Thanks, Maria, for having me here. It's nice to see you and share stories as fellow entrepreneurs, and definitely with having the ecosystem approach that ED4S has brought. I feel like we're kindred spirits, and I'm more than excited to share some of my experience and knowledge with the listeners.
Yeah, and we have a lot of listeners in Montreal, actually. So for those of you who are in Canada, Montreal, Jason is also based here. I'm pretty sure you've already heard of him. So before we get started with the technical questions, Jason, I just wanted you to walk us through your journey. How did you end up in sustainability with your finance career? And tell us a little bit about Climate Finance Advisors.
Yeah, thanks. Would be happy to. So I had a bit of an atypical journey. So I started out in structured finance and derivatives. I was very passionate about risk management and the role of derivatives and moving around risk between institutions that could assume the risk, i.e. speculators and hedge funds in New York and London, through the work at the Montreal Exchange, and taking it off the balance sheet of the investors that actually have some type of institutional constraint for that risk. Think financial institutions, banks, governments, pension funds, and so on. So at the base, I had a bias towards structured finance. I've always maintained throughout my career an outlook on a continuous improvement outlook. I've noticed finance over the years become very rapidly more complex and requiring a lot of different skills along the way in order to be able to grow in the career. So I've gone through the CFA program, and then I went through the Kaya program for the alternative side on the asset classes, and then through my MBA and progressively along through a sustainability master's that I'm in the process of completing. And ironically or surprisingly, at times I learned things I thought I would never use that I would draw on 10 to 15 to 20 years later. And I'm grateful for all that learning I've had along the way. Through that journey, I learned that it was just almost as important to be aware of my gaps, my known unknowns, than it was to be able to do very good discounted cash flow modeling, for example, which I feel I can do reasonably well. And so at one point, I was being presented as an expert in sustainable finance, despite the significant gaps I had in my profile. So I went back, and that's why I decided to evolve from my MBA into my master's in sustainability. I've also uncovered a fantastic ecosystem in academia here in the Montreal community, whether it's at HEC Montréal or at Concordia or at McGill. So I feel like we're really well surrounded here to mobilize all that deep level of expertise and put it to the benefit of industry, which I feel oftentimes, and having ED4S intermediate all that, I think is going to have an outsized impact on the market going forward, especially as we've seen the headwinds on top-down policy of how they can be erased in one pen stroke, and we can rewrite and even erase history from one election to the next. So my investment outlook is really that we can achieve a much better alignment on finance and sustainability. We very easily should be thinking about reducing externalities, even as people move to an impact paradigm. I think of a lot of it in terms of creating an efficient investment frontier, and we really look on leveraging the power of capital to affect systemic behavior change. So yeah, lastly, quickly, just through my work at Goodman Institute and their CFA MBA program, I often encourage the students to use finance as a force for good and remind them that they have a very conscious decision to make of whether they want to build economies and societies or they want to be part of deconstructing them. So I really feel that really where our firm, when I left banking, was to shed the institutional constraints so we can be more creative. And we really feel that mainstream finance will run its course and the last miles will come from structured finance. So we hope to flip the paradigm around of how society can benefit finance to how can finance better serve society and not vice versa.
Super interesting. So, Jason, we'll dive in a lot of that content later on, but I want to zoom into that one story that you told me a couple of years ago when we first met about how did you actually get your first foot in the door into a sustainability role at Scotiabank? And then how were you able to actually build the business case, build the team scale, and then make it as a profitable money-making machine? Because in today's episode, we do want to really focus on business case for sustainability work.
Yeah, I would be happy to. So thanks for that. It brings back some very fond memories from that time. It went by in a blink. I'd say it's important to do the work in the background in order to be able to seize those opportunities. So a lot of people talk about manifesting your own luck, but at that time when I was going through my MBA, I was very grateful for my thesis or my final paper supervisor, Luciano,
Yeah,
who's from HSC, who's
it's well
strong
known.
to me. Yeah, and he's become a leader, and I think you guys have collaborated. And so he strongly encouraged me to pivot from social finance to a sustainable finance paper. So I was able to write that paper and submit over 30 recommendations to the expert panel on sustainable finance. And one thing led to another. And I was about to go and sign a contract at a pension fund after a couple months of a recruitment process and called them the night before to say that I was withdrawing. It was not, I didn't sleep that very well that night previously leading to that decision. But at that time, the bank had just underwritten its first sustainability bond with the World Bank, where proceeds were going towards women and children. And so that obviously piqued a lot of the executive team's interest. The timing coincided with the fact that Tiff Macklem, now the governor of the Bank of Canada, who at the time was on the board of Scotia and on the expert panel. So the top-down executive level champion opening up the road and having that percolate all the way down into capital markets was a big reason why the bank was able to move and mobilize so quickly. I was a bit hesitant at first, not knowing what I was getting myself into. But I think, I was very grateful for my family just to encourage me to do it and say that regardless of the outcome, the sun would rise the next day and the next morning. And to them, it was really important. I also had a manager at the time that was very talented and gifted and who was able to see and think in a lot of different dimensions, and saw this vision ahead of a lot of people and was able to create the conditions where I could integrate it more at the transaction and desk levels. So the resources and conditions were certainly in place. At the time, was given a lot of autonomy on the build out and the decision making. And I was able to influence the bank to bring a team of analysts and directors who were bringing new abilities to the bank, because presumably we wanted to gain an up tier and market share. And we had to do that. We had to think differently, which meant we have to hire people with different backgrounds. So we had staff with green engineering backgrounds, circular economy backgrounds, environmental sciences, and so on. And one who brought a very transition-centric professional experience and background. So we wrapped all that together, and we would merge these abilities with the traditional finance teams across a lot of the different desks, and we were able to design together as a village. And so in the beginning, we missed most of the transactions. It was at one point we were really doubting ourselves, but our manager designed a very detailed business plan. We stayed very focused on the mission and the vision and the model. And eventually the dam broke, and we went on a pretty notable transaction streak there, which was a bit out of the ordinary at that time.
Yeah, do you remember how much?
It was quite rapid, the ascension in league tables. I remember looking at Bloomberg league tables globally, and the bank was in the 70th or so rankings, where they take all the banks around the world and they classify them on the transaction volume. And within a matter of a couple of years, the bank was in the 20s.
Wow. just due to sustainability related to bond issuance?
Correct.
That's impressive.
That's exactly right. And so what we took away from that was that this was not a check the box type of exercise. It was really a way to up tier. And if you looked at traditional league tables, both in Canada and globally, in Canada, we started, I believe, in fifth because we were a bit behind some of the incumbents. And within a 2-year period, at a point, we were leading league tables in Canada, despite having the smaller balance sheet than some of the other peers. And so there was really, in finance speak, an alpha generation ability through doing this. And so you can really measure indirectly the growth on the P&L by headcount because its headcount is is a very return driven decision in capital markets. So, and a lot of these people in the team really ended up getting a lot of promotions. Their compensation increased beyond levels they could never really have imagined starting out their career. Just because the bank valued those abilities differently. The team's still there today doing some very sophisticated transactions, but they do it as a village approach. Their relationships are very strong across the different teams. There's a shared value creation paradigm. Everybody's equal. There's no real ego. The client's at the center of decision making, and these people are really working on optimizing transactions. So brings back really fond memories. And so a university hired a researcher to study the success factors because, after all, it is a 140-year-old institution. And we were isolated to capital markets, but it's still a fairly significant balance sheet with a lot of complexity and regulation. To study the success factors of how you can create conditions to mobilize quickly and then disseminate those for learning and build capacity. And because of my move to follow after I moved to another bank, and that case study never was completed, but I do think it does make for a good learning tool for how you can mobilize financial institutions in a non-altruistic, simply from a P&L perspective.
Yeah. So just for our listeners, they're not from banking background, right? Like, just to give them a bit of a better idea, how is bank making money when they're helping issue bonds? Could you just give us an idea of, like, what's the percentage? What type of amounts are we talking about?
Yes.
And what portion of that goes to the bank, basically, as a profit?
Yeah, for sure. Happy to. So the banks are monetizing sustainability in a variety of ways, I'd say. Originally in Canada, it was very bottom up. It emerged from the business lines, largely promoted by the development banks. So the development banks made a conscious decision to develop these markets. And then over time, they've migrated across different verticals and business lines. So we talked about debt capital markets. So that's the underwriting of green bonds. And I would say, based on the $20 billion approximate issuance volume in Canadian dollars, there's probably a couple to a few $100 million of fee-based revenue there. And that revenue is interesting from a banking perspective because it often ties up very little balance sheet. So it's very balance sheet efficient. And what's interesting about that is that there's a lot of ancillary business that goes around that, which may be a bit too technical for the listeners, but know that it's, generally speaking, a very profitable business line. And so that said, though, the 20 billion on broader issuance in Canadian dollars, I believe, is probably somewhere at best 10%. So we can see that there's still a significant amount of funding in Canada that's not green, and which probably explains why a lot of the funding gaps still are so wide, which we'll get probably a better reading on at COP30 in Belém, where they usually refresh the funding gaps. From there, there's been some work done in investment banking. So in another scenario where I was asked to build out the function at another bank, we were fortunate to tilt at the time of what was considered a very high profile IPO, jump ball, Canadian banks, US banks, bulge bracket firms. And it was communicated to the executive team that the sustainable finance team was able to influence and tilt that decision to the point where the US banks that were not appointed sustainability structuring advisor on the IPO, one of them created an identical role the following week. And we know that US banks are also a for-profit driven organizations. So what was interesting with that on the US banking approach is they were able to mobilize teams very fast and quickly. They're known for mobilizing a lot of talent very quickly, and they've been able to establish themselves in these areas. But this is all fee-based business. The other area where I think banks are also making, to some extent, a little bit of money on sustainability, but nowhere near the potential it has, is on the asset management side. They've rolled out ESG integrated funds to some varying degrees of success, and they're now starting to look at more thematic based funds. But you can see the institutional constraints there as well, and how they haven't been able to mobilize. There's a significant generational wealth transfer in the trillions of dollars that's starting to take place that many of them aren't well positioned for. And as such, we've seen independents monetize the opportunity in a much more efficient manner, and presumably because they're less constrained. So, for example, there's some funds here locally. AlphaFix, for example, has been a very big success story in the space. The Addenda team also has done some very, very strong leadership work in there as well. So, and then there's the lending side. But I think where banks fail is on the top down side, how to structure and plan for this and monetize the synergies across those business lines in a more measured way. I'd say also we have to do a lot of demystifying on the non-sustainability business models. And so I often hear, people question whether green assets, or make the statement that green assets are too expensive. But I often wonder if it's really the brown assets that are too expensive. And so if we remind ourselves, the largest bankruptcies in history have come from non-green companies and non-sustainable companies. And if we keep...
Yeah, for governance, right?
Yeah, exactly. And so what I find interesting about that is, and this whole topic in and of itself, is if we look at wealth creation, wealth destruction, in some cases, up to 3/4 of active managers have underperformed the benchmark in non-sustainability mandates. And so asset owners have been paying a substantial amount of active managers to effectively, what we call in finance, pay them to destroy wealth as they underperform the index. So I feel like these things need to be spoken out loud, or I guess not necessarily spoken out more loudly, but just, I think, be brought into the discussion in a bit more balanced way. I'm not saying that, either one are silver bullets, but I think that the overarching theme here is that this area, whether sustainable or non-sustainable, is very complex. And I think that I think we've seen examples of when people apply the resources to this type of work, it can be very effective. So,
and I think it's also that vision. I personally, and I don't know if you could share this opinion, but feel that lots of high-level executives, CEOs, especially in finance banking, because they're so focused on the next quarterly results, they kind of bypass the systemic view of looking at beyond 5 years, 10 years, like we're talking scenarios. And actually something I've heard not so long ago was an insurance expert or the credit rating risk expert. I apologize, I don't remember who it was exactly, but it was fascinating to hear that actually for a bank, whether we're on a 1.5-degree scenario, 3-degree scenario, or 5-degree scenario, it doesn't matter. Bank is making money anyways. So I feel it's a very biased view, which does not reflect the realities that our businesses, our finance, our banks operate within ecological limits and social limits. And that at one point we'll be bursting those. And I guess it's a tragedy of the horizon that Mark Carney keeps on talking about. So just to kind of wrap up this argument about business case for banks, as you mentioned, there is an investment side, the asset management side. There's investors now increasingly looking for this, and studies show on and again. It was actually a topic of our last podcast as well, talking about the financial advisors not offering enough of those products while there is appetite. So there's clearly a gap there. And on the other side is the lending, right? The issuance, funding the transition. So as kind of like a wrap up opinion, Jason, do you feel that there's enough return on investment for the banks to try to allocate more resources and efforts towards sustainable products today? Or is there still not enough credible returns that are being seen?
I think so I definitely think the way you framed it, it's a time horizon thing with the way if we look at it from a pure sustainability perspective, there's now the 7th planetary boundary was breached in 2025, which is ocean acidification.
The ocean.
In terms of the capacity of the economies to consume the Earth's natural resources and abilities to regenerate itself, the world is now consuming almost 2 planets per year. So the point at which, so the clock at which where the Earth has consumed once its carrying capacity keeps arriving earlier and earlier. This year was in July. And so when you think about there's impact of finance, but there's dependency on finance. And if you look at the physical risk, this past summer, there was a landmass the size of the province of New Brunswick that was affected by forest fires. And so New Brunswick is not a small province either. And those conditions are going to be deteriorating as emissions and the impact on climate change has a lag. So in some cases, researchers estimate around 50 years. So when you talk about the impact, it's one thing, but the dependency of financial institutions to maintain that level of profitability over time and how does that affect solvency ratios and capital requirements, I think really puts a big question mark on that. And it really comes down to thinking about it. I really appreciate the Indigenous way of thinking in terms of 7 generations. It comes down to an intergenerational equitable transfer of natural assets and quality of life. And so if we look at the air pollution and the externalities caused by air pollution, the social cost, and how that translates into the social cost of carbon, meaning the cost to treat those emissions. And we look at the flooding and all the effects that flooding has had in Canada and how it affects supply chains and just the psychological effects of that on people and the well-being. I think it's very naive to think that institutions can maintain that level of profitability if something doesn't
Yeah.
change.
Yet the credit rating and the stock prices, they're all just focused on quarterly, annual. And so there's this big disconnect. Which do you think banks would still act today, given that there's externalities, they're not priced in and nobody looks at them? Do you feel there's still money to be made today without those externalities kicking in yet?
Oh yeah, I think we're really into the way I think about it, and our firm thinks about it is about compensated risk taking. And so risk in and of itself, I think that's what we need to do is move away from altruism and just look at it in terms of risk and reward. No different than anybody would treat, for example, FX risk or interest rate risk. These institutions are paid to take risk, by the way. If not, we would simply be invested in treasury bills, and we're not. And so the managers of banks are paid to take risk. And so it's a question of really just being compensated for that risk. And I'm not convinced that shareholders are being compensated for that risk taking at the moment because of the limitations on disclosures, and no disclosures and prevents you from pricing it. And I don't even think even shareholders can hedge themselves from these profiles because
it's a systemic risk.
So because there's this systemic component. Yeah, absolutely. So I do think we talked about how, the great general wealth transfer that's taking place is going to be going into the hands of a part of the demographics that's ultra sensitive to sustainability. And in fact, I'd say it's even visceral to millennials. And so I think there's going to be a catalytic moment where millennials are going to start to reject this so-called perceived return at all cost and want something a bit more aligned with their values. We strongly believe that you can earn an honest living out there and you can do it without having to destroy the water tables and air pollution and so on. So, and they're going to pay fees to manage their assets. We, as a firm, work with a handful of asset owners and they have external managers and they pay fees. And those fees aren't lower because they're green fees. They pay the same level of fees as non-green mandates. So there's a clear business opportunity on the asset management side. The DCM case, there's the IB case. And there's even some structured finance opportunities, I think, that the banks are leaving on the table. So for me, and I also think on the IB side, some of these small companies today are going to grow very quickly. We can think about electrification, OEMs, clean tech. We can think about some of the participants on the transition supply chain that are going to grow extremely fast. And so it's our strong belief that the index composition, both across the world, developed or undeveloped, is going to change over the next few years substantially. And we do strongly believe that the incumbents that will fall out will be the ones that have failed to adapt, and the new incumbents will be the ones that are better aligned with an economy that's 5.0. So And we also use it as a talent signal. I think, at the end of the day, it's about risk return and alpha generation, whether as an investor or as a manager of an institution. But those that can integrate sustainability well, we would, subscribe to the research, early day research from Harvard that it probably suggests that they do the more mundane operational stuff really well. So there are firms, and for example, there's been a very big success story in Quebec here with H2O Innovation growing very rapidly, addressing the water gap, addressing water tech, addressing social issues. And I think for banks, those that are supporting them appropriately, I think would be very well compensated. And that's just one of many examples. So I for sure, but I don't think it's a silver bullet. I think you still need to apply good, sound financial fundamentals into decision making, and you have to stepwise it. And sometimes you have to structure it as a green bank as a subsidiary, as opposed to trying to green the holdco, which could be harder to do. But yeah, I mean, we may for sure, I could appreciate we appear biased, but I've worked on both sides of finance. And I do feel that there are some very compelling opportunities here. And some banks are mobilizing on it now as we speak.
Really interesting. Well, I'm happy you mentioned the H2O, and we do speak with financial advisors. There's still so much misconception, and there's a really deeply rooted belief that if you're doing sustainability, you're losing money or you're foregoing returns. And we do need more and more of those case studies to demonstrate that it is absolutely not true today. There are opportunities, and hopefully there'll be more. And that should lead to growth in impact investing strategy, hopefully. All right. So Jason, we're coming close to the end of our episode, but I do have two more questions for you. The first one, as you know, we are focused on skills building sustainability. Earlier, you mentioned that as you built out your team at Scotiabank, I think you started as one person show, two people, and you grew it all the way to, I think, 30. Is that what you told me before?
We were 10. We were
You were
around
10?
10. Yeah.
Okay. Okay. So you went from one person to 10 people, and you onboarded some environmental engineers, some technical science background individuals, which is very uncommon for a bank. So could you tell me, other than this very special deep expertise, when we're talking about broader financial knowledge, like employees of a finance of banking, what kind of skills gap do you see which potentially holds them back from capturing those opportunities or potentially addressing the risks that come with sustainability? Could you just name a couple of them, and how would this potentially impact their work or outcomes?
Yeah, I'd be happy to. I think really to go furthest, those sustainable finance teams actually cut their nose off to spite themselves because they become a bottleneck and out of all good intentions. And the reason I say that, and it might appear a bit strict, but we need a systems level change. And the banks have several thousand transactions going through on a daily basis, which means that there's no other choice than to integrate it bottom up at the desk level and mainstream it. So I think we're now starting to see the next generation of students integrate sustainability courses and training along the way. So really the program at the Goodman Institute is designed to train the next generation of portfolio managers in their MBA CFA program to integrate this no differently than they would any other financial technique. So I think that's one way of doing it. And we're in a situation where right now where one of our analysts in the firm has come out of an environmental science background, but is now progressing through a CFA. So I feel like merging those two worlds for those that have time and really want to go as far as they can on these skills and abilities, combining some kind of combination of sort of deep finance and maybe call it deeper sustainability or vice versa over time. It does take a long time to build that skill set, but I think over the long run, it'll allow a candidate to go further and faster in their career if this is really something that they're interested in doing. And so I think it's an investment in upskilling that, from my experience, has been very valuable, but not only from a financial perspective, I would say from a quality of life perspective, from an intellectual quality of life perspective, from the relationships that you make along the way, the networks you get invited to, the projects you work on, the transactions you work on. So I think that said, there's still important programs that you can do along the way. in smaller bite size that allow you to progress rather than doing a hard stop to go do a program. So you guys are doing an amazing job providing that ability, which is just as important in my opinion.
Yeah, well, that's actually, I definitely agree with you because I do hear a lot of the time sustainability leaders are being elected into those roles within the corporation where they really don't understand the businesses, that they how is the money made, who's doing what, the department. It's so complex, especially in the bank, right? They've been selected because of maybe their background in social sciences or environmental sciences, but you cannot move the needle if you don't understand what are the vested interests, what kind of politics are going on, who's doing what, and what are division-based goals. And that really requires the cross-functional understanding, right? If I just understand environment and I need to convince a finance person, I better understand the finance to talk their language. So yeah, like Nawar El-Sadi, our advisor, has very well said in some of the earliest episodes, it's really a translations job. And you need to be fluent in those various languages, whether it's finance, accounting, IB, or DCF. So really interesting to kind of see how professionals of tomorrow are going to widen out those spectrum of capabilities. All right, so very last one, our typical question, the magic wand. So you're now the whole mighty magician and you get to get one wish that could potentially solve in the financial sector the sustainability gap, whether it's around the policy, processes, structure. What would be that magic wand wish that you would put in place?
Yeah, I think I hope that people will come together and build the country's economy and society together. I really much believe in shared value creation, but sometimes I may be sitting on a cloud and dreaming when I think of that. If we really want to have any chance of succeeding over the long term, capital charges simply need to be adjusted and reflect the full extent of the risk that capital providers are taking on. And so until we have sustainability adjusted capital charges at the regulator level, I think the market's going to continue to bump along and continue to fund the externalities that we've witnessed over the last summers, the heat waves, we talked about the flooding. So
yeah,
obviously that's going to be a very politically sensitive conversation and topic. I think with the headwinds that we have now, I don't know that necessarily the most realistic expectation, but I sure know that our grandchildren would really appreciate it if we would think along 7 generations like the indigenous communities do. And I would say that I also feel that in order to have a more efficient capital allocation, we should be adjusting financial performance for externalities. I think if we did that and we factored back in water stress, social causes from income disparities and wealth disparities, and obviously the social cost of carbon on emissions over time, I think a lot of the financial performance we feel that we're buying today or being told to buy is really artificial. So until we do that, it's going to be an uphill battle. So
we're getting a discount basically. So the mentality is buy more because it's cheap now, right? Which is completely counterintuitive. But yeah, excellent point. Thank you, Jason, so much for joining us today. I hope our listeners enjoyed this and we'll see you soon.
My pleasure, Maria. Thanks for the great interview and the thoughtful questions.
Take care.
Bye.